Recently, I've taken to explaining my investment approach to being akin to pension style management. Some people have told me they're unsure what that means. Pension style management refers to an investment approach that mirrors how large institutional investors, such as pension funds, endowments, and sovereign wealth funds, manage their assets. It focuses on achieving long term stable returns that can meet future liabilities rather than chasing short term performance. Let's look at this in practical terms. The key features of pension style portfolio management are as follows. Taking a liability driven approach, the strategy is designed around meeting future obligations rather than simply maximizing absolute returns. Now, obviously, this aspect doesn't map totally accurately for individuals. Pension funds have an indefinite time horizon, whereas individual investors have limited lifespans and health spans, but the principle applies. Taking a long term perspective. This point is crucial. People in both the retail space and the pension space talk about taking a long term view for best results. But the words long term mean different things to different people. One thing that strikes me as relatively unimportant is short term liquidity. Basically, if you're genuinely taking a long term perspective, then using products that might require 90 days notice to sell shouldn't be an issue. Diversification within and throughout asset classes also matters a great deal. Harry Markowitz won a Nobel Prize for his work in modern portfolio theory, which demonstrates that people can achieve better risk-return trade-offs by adding asset classes that zig when others zag. As such, pension-style portfolios are built using a wide mix of assets, such as public equities, bonds, real estate, infrastructure, and private options for those same asset classes. This means looking for options that have weak or negative correlations. Comprehensive diversification is the best way to balance risk and return. Having a risk management focus. Portfolios are built with an emphasis on controlling downside risk and maintaining portfolio stability. People often get good, but not necessarily great, returns, but they seldom face significant drawdowns when they use portfolio management like this. That's especially important for retirees who can't afford to see their nest egg eroded when they're no longer earning an income. Using low-cost passive options for public asset classes. Pension-style asset managers prefer low-cost index funds and factor investing rather than frequent tactical bets for public assets. Note that private assets cost more because they simply cannot be accessed as cheaply. Decisions are made within a structured investment policy framework. Risk management is paramount. This involves the conscious choice to give ultimate control to a disciplined portfolio manager who can often reduce the emotional or reactive aspects of decision making. Many people understand the concept of buy low, sell high, but lack the strategic focus and discipline to follow through. Allowing a fiduciary to do so on your behalf not only reduces stress, it increases the likelihood that more purposeful action will be taken when needed. All told, pension-style management is about investing prudently with a clear objective tied to long-term goals rather than short-term market movements. An ordinary retail investor would likely define pension-style management in simpler, more practical terms. They might describe it as investing steadily for a long term with a focus on safety and consistent growth. From their perspective, the goal is to build a reliable retirement pot, not to beat the market each year. They're likely to think in terms of having enough money to live on in retirement. And as such, pension-style management could be equated to a set-it-and-forget-it approach with steady contributions or withdrawals, diversified holdings, and minimal trading. Ordinary investors generally interpret the phrase pension-style management as long-term, conservative investment strategy focused on retirement stability. And that works for me. However you define the term, pension-style management offers a clear alternative to the way most people invest their money. There's no chasing hot products or sectors. Instead, the approach involves a win-by-not-losing philosophy that puts a premium on capital preservation to maintain a reliable income stream over an investor's lifetime. As markets become volatile, that provides real peace of mind.